The global financial system stands at a historic crossroads as the US dollar's decades-long dominance faces its most serious challenge yet. What began as gradual de-dollarization efforts among geopolitical rivals has accelerated into a full-scale retreat from the greenback, with even traditional American allies quietly exploring alternatives. The numbers tell a sobering story. Since the current administration took office, the dollar index has plunged 12%, while central bank dollar reserves have fallen to their lowest share in over 2 decades. But these statistics only hint at the deeper structural shifts occurring beneath the surface of global markets. At the heart of this crisis lies a profound erosion of trust in American economic stewardship. The Federal Reserve, once seen as the gold standard of monetary institutions, now faces unprecedented skepticism after repeated political interventions and policy reversals. When the world's reserve currency issuer engages in erratic decision-making, one moment flooding markets with liquidity, the next aggressively tightening, it creates whiplash effects that ripple through every economy on Earth. Emerging markets particularly feel this instability, having been forced to absorb the consequences of U.S. monetary experimentation through currency crises and capital flight. The geopolitical dimension of this dollar retreat cannot be overstated. What began as cautious moves by China and Russia to reduce dollar exposure has snowballed into a broader movement, with over 20 nations now implementing formal mechanisms to conduct trade in alternative currencies. The BRICS bloc's expansion to include major commodity producers like Saudi Arabia and the UAE has created a critical mass for non-dollar trade systems. Their newly launched payment platforms allow participants to settle transactions in local currencies or commodity-backed units, bypassing dollar clearing entirely. For energy exporters, this represents liberation from the petrodollar system that has forced them to recycle earnings into U.S. assets for generations. Latin America's shift away from dollar dependence reveals how quickly the landscape is changing. Brazil and Argentina now conduct most of their trade with China using yuan settlement, while Mexico's central bank has quadrupled its yuan reserves. These aren't merely symbolic gestures, they reflect hard economic calculations. When the U.S. weaponizes dollar access through sanctions as it did with Venezuela, other nations take notice. The message is clear: reliance on the dollar comes with political strings attached that many governments are no longer willing to accept. Corporate America finds itself caught in the crossfire of this monetary revolution. Multinationals that built global supply chains assuming permanent dollar supremacy now face a harsh new reality. Apple's overseas cash reserves have lost billions in value from currency shifts alone. Tesla faces production delays as suppliers demand payment in euros or yuan. Perhaps most tellingly, Walmart's international operations now report earnings in local currencies rather than dollars, a small accounting change with enormous symbolic significance. The S&P 500 stagnation reflects growing investor concern about U.S. corporate profitability in a world where the dollar no longer confers automatic advantages. Financial markets are sending unmistakable warning signals. Gold prices have soared to record highs as investors seek alternatives to dollar-denominated assets. Bitcoin's resurgence reflects growing appetite for decentralized options. Even the Treasury market, the bedrock of global finance, shows signs of strain, with foreign ownership of U.S. debt declining steadily. These aren't temporary fluctuations but symptoms of a profound loss of confidence in the dollar's long-term stability. The weaponization of dollar dominance through sanctions has proven to be a historic strategic miscalculation. By cutting off Russia's access to dollar payments, the U.S. accelerated the very de-dollarization it sought to prevent. China observed this carefully and has since built alternative financial infrastructure that now handles over 50% of its cross-border transactions. The SWIFT system, once unchallenged as the plumbing of global finance, now faces multiple competitors offering dollar-free alternatives. Energy markets illustrate the transformation most dramatically. The petrodollar system that has recycled global oil revenues into U.S. assets since 1974 is unraveling. Saudi Arabia now accepts yuan for up to 25% of its Chinese oil sales, while Russia trades energy exclusively in non-dollar currencies. Even U.S. allies like India have begun settling oil purchases in local currencies. Each such deal chips away at the dollar's privileged position in commodity markets, the foundation of its reserve status. The political dysfunction in Washington exacerbates these trends. As lawmakers lurch from one debt ceiling crisis to another, foreign observers question whether America can still be trusted with the world's reserve currency. The partisan battles over spending and taxation reveal a political system increasingly incapable of addressing long-term challenges. When the world's economic leader can't maintain basic government functionality, why would anyone hold its currency? Emerging technologies are accelerating the dollar's decline. Digital currencies, both state-backed and private, offer new ways to transact outside traditional banking channels. China's digital yuan already facilitates cross-border payments without dollar intermediation. Cryptocurrencies, despite their volatility, provide an exit ramp from the dollar system for sanctioned nations and wary investors alike. The technological genie cannot be put back in the bottle. The human impact of this transition is often overlooked. American workers will face job losses as export industries become less competitive. Retirees will see purchasing power eroded by persistent inflation. Developing nations caught in the middle of this monetary Cold War will experience renewed volatility. There are no winners in a disorderly decline of dollar dominance, only degrees of loss. Yet for all these challenges, the dollar still retains significant advantages. No other currency offers comparable depth and liquidity in financial markets. The euro remains hampered by structural flaws in EU governance. The yuan faces capital controls that limit its appeal. Japan's aging population constrains yen adoption. In the short term, the dollar's position may weaken but not collapse entirely. The coming years will test whether America can adapt to this new multipolar monetary world. Maintaining dollar relevance will require difficult choices. Fiscal discipline to restore confidence, diplomatic restraint in using financial sanctions, and investment in maintaining technological leadership. The alternative is gradual erosion of economic influence and living standards. What's certain is that the rules written at Bretton Woods in 1944 no longer govern today's economy. The artificial advantage the dollar has enjoyed for generations can no longer be taken for granted. As other nations develop alternatives and technologies enable new systems, the U.S. must earn its currency's dominance rather than assume it. If you found this analysis valuable, don't forget to like and subscribe for more insights. Until next time.